For more on the markets, joining us now is Dan Skelly, Morgan Stanley Wealth Management, Managing Director, Head of Market Research and Strategy Team. Dan, it is good to see you. On the Fed, Dan, I thought you made an interesting point here. You say the longer the Fed keeps rates restrictive and allows lagged effects to impact the economy, the more the haves and have-nots may diverge. What did you mean by that, Dan? Walk us through it.
Sure, Josh, and thanks for having me back on the show today. So, simply put, we have seen certainly a set of mixed data across the economy, across the consumer environment. But I think more and more we're getting clarity that, like I said, the longer rates stay higher, the more you're going to see this divergence between certain corporate and consumer cohorts who are more rate insensitive and those who are less rate sensitive. And frankly, you can intuitively think about all the different applications of that concept. But on the consumer front, it's playing out in terms of high income versus low income, homeowners who have fixed mortgages versus those who are maybe trying to buy, and then, of course, renters. On the corporate side, look, it's the reality that there's a certain cohort of large companies that have net cash balance sheets. And they're actually seeing their interest income exceed interest expenses, given the rate environment on the short end as well. And then there are companies, frankly, more down the cap curve in small cap land who have more leverage, who are, frankly, seeing the pain from high rates.
Dan, it's Julie here. So as you look at that have and have-nots then scenario, what are the implications then for the economy and the markets? Because we've heard a lot of economists come on the show and talk about how the upper echelons of income account for the bulk of consumer spending anyway. So, talk us through sort of the implications of what you're saying.
Julie, it's great to be with you as well. And you make a really astute point, which is, mathematically, if the top income cohorts account for the majority and the lion's share of spending, if that second track starts to degrade or slow down, can that actually move the overall averages? And our view is likely not. So Morgan Stanley, from a firm perspective, is still in the soft landing camp, right? So we still see, albeit two-track divergence amid these different groups, we still see the overall picture as fairly positive. But it puts the Fed in a really tricky place because, frankly, just keeping rates higher isn't necessarily changing the behavior of the one track that isn't rate sensitive, right? And in some instances as well, if you're cash rich and you're now seeing 5% yield on cash, you're then taking that income perhaps and going out and spending more, which, you can make the case, it's a bit counterintuitive, but you can make the case that rates staying at these levels perhaps is supporting high inflation in certain services.
So, Dan, if that's sort of your views on the Fed, the economy, where we're at and where we're headed, what are the investment implications, Dan, for equity investors listening right now?
Absolutely, Josh. So I'll say two things. First, in the near term, it's just more of the same, right? It's not trying to get too creative by fighting the momentum in some of the larger cap, cash-rich type business models who are not only seeing the benefit from essentially being insulated from high rates, but also benefiting from these idiosyncratic spending trends, whether it be in the tech sector or semis or in some of the internet and software areas, whether it be in the industrial sectors where you're seeing massive fiscal spending on certain priorities. You essentially don't want to fight some of the earnings power, some of the momentum in these areas. Having said that, though, Josh, the second thing I would say is you want to start thinking about a world like 6 to 12 months from now where, frankly, some rotation may start to finally occur. And what would we be thinking about in terms of those themes? Well, look, our base case, again, is a soft landing scenario where the Fed is cutting later this year. Ellen Zentner, our economist, who I think has had this call as close to spot on as anyone, is still looking at potential for 3 cuts this year. And so at a certain point, Josh, the puck is going to start going to more value-oriented parts of the market, more, frankly, cyclical parts of the market. And that is something we are thinking about coming into the end of this year.
I was going to ask about timing there, Dan, because that is a call that, that's out there that hasn't yet come to fruition. Is the signal for that going to be when the Fed starts cutting? And by the way, as we're talking about cutting, I think the last time we talked to you, you were still looking for 3 cuts this year, and I wonder if you're still there.
Sticking with three, so I'll answer the second part first, which is, we had thought the path of disinflation would be lumpy in the first half of this year, and that played out to a T. The first quarter had some seasonal factors. It had some issues that certainly we thought were more one-off. And look, as per the last 2 months of data, it does look like that glide path towards the Fed's goals are more in scope, right? And so we do think the path of resuming disinflation is getting there. And look, importantly, as you know, the Fed has explicitly said, we're not going to wait to kind of stick the 2% landing exactly before we start cutting. And frankly, I think that's pretty wise because, as you know, there are structural issues that have frankly built up since the post-08 environment in terms of housing supply, in terms of labor shortages, that frankly, I don't think we're going to really solve with any type of monetary policy in and of itself. And so I think if the Fed sticks to that guidance in terms of not waiting to the 2% landing, I think you can start to think about positioning in some of those value parts of the market coming into this fall. Now, as you said, a lot of people have tried to make that call so far. It's been difficult because, frankly, a lot of the fundamental earnings revision, like I talked about, and momentum has been in some of the other growth sectors.
All right, Dan, thanks a lot. Good to see you. Dan Skelly, great to talk with you again.